Good afternoon, everyone. This is Antonis Polemitis. We are on session 8 of MOOC 9, Central Banking and Cryptocurrency. This session, we're doing it a little bit casual Fridays. It is Good Friday here in Cyprus, and the university is closed, and I was out and about, and we'll be doing this session from my veranda. So a little change of scenery for this session. So I hope everyone has been well. I hope everyone had an excellent set of sessions with Andreas Antonopoulos on some of the technical aspects. And now we're going to go through several sessions of how cryptocurrencies might be interacting with some of our real-world institutions or existing institutions in the financial, legal, and political systems. Today, we'll be looking at, in particular, central banking. There's a good set of questions that I'll try and go through, and Andreas will keep an eye on the chats and see if there's anything else if we have time, anything else we should get to. Okay. First question. What regulations could be imposed once central banks realize cryptocurrencies are a danger? Well, this is a question that is stated in the future tense, but I think it's really actually relevant in the present tense and maybe even in the past tense. Cryptocurrency around the world is subject to many, many different regulations and many, many different levels of regulatory supervision depending on the country. So let's say, medium ground is a country like the United States, where it is absolutely legal. And, are we having connection problems? Hold on one second. Let me retry this. Andrea, am I live again? Am I live again? Okay, let's give this a shot, and if this doesn't work, I'll move inside. So what I was saying is, the question was, what will happen when central banks think cryptocurrency is a danger, and what type of regulations might they impose? And my view on this is that this isn't a future state of the world, it's a current and even a past state of the world, that a lot of central banks have made a lot of statements about cryptocurrency, and a lot of countries have a variety of regulations and a spectrum of regulatory control over cryptocurrencies. And we'll do a medium example and an aggressive example and a non-aggressive example. So a medium example, I would say something like the United States. The United States has been looking at cryptocurrencies for many, many years, and it's regulated in a variety of ways. So from a tax perspective, it's treated as a capital asset. Exchanges are viewed to be money transmitters. So where cryptocurrency comes in and out of the traditional banking system, it's treated like the traditional banking system in terms of know your customer requirements and anti-money laundering requirements. And when you have new issuances, the securities regulators are involved. However, having said that, the United States clearly has taken the position that cryptocurrency is legal. Mining is effectively unregulated. Having a wallet is effectively unregulated. Owning cryptocurrency is effectively unregulated, again, subject to paying your taxes and so on. So this is, I think, a very normal standard view for developed nations with open economies. And by open economies, freely traded currencies. You take a different example, China, and as of a couple of days ago, India, have taken a much stricter line on cryptocurrencies, where effectively they have banned open trading in cryptocurrencies. And the reality is, in a country like China that has capital controls, that does not have a fully convertible currency, it is a logical conclusion of having capital controls. Because if you allow cryptocurrency exchanges to operate freely in a country that has capital controls, it becomes an easy way to move that country's currency or wealth that was in that currency out of the country with going around the capital controls. So if I have a million yuan and I go to an exchange and I use it to purchase Bitcoin, and then I take the Bitcoin into my wallet and then I send it from my wallet to someone else's wallet, let's say in the United States, and that person can then, well, if that's all they want, then we're done. But even if I want US dollars at the end, those can go to an exchange in the United States and we have US dollars at the end. So I think it is fair to say that cryptocurrency is incompatible with capital controls and a non-freely convertible currency, or even a country where the country has concerns about the stability of the currency, because it's an easy end run around those controls. So we would expect to see a lighter hand in countries that have open economies and freely traded currencies, and a heavier hand in countries that don't have that. And so far, that's played out. There's an interesting case in Russia where Russia is, I think, the only major country that has gone in the opposite direction, in that it started more negative and is moving more positive. So there was a couple of years ago a lot of talk about how it should be banned or shut down or what have you. And now they're heading towards some type of legislative framework by this summer. So they're an interesting counter trend of a major economy, whereas China has gone in the other direction. It was more open and has become less open. So let's say that's the category of kind of strict. Then there's a bunch of countries that, in effect, haven't gotten around to having a coherent policy at all on it. And there, it's not clear what the framework is. And then say there's a fourth category, let's call it regulatory competition category, the countries who want to attract cryptocurrency businesses to their country, and they're saying, oh, we're very welcoming of this, please bring your startups here. And some of these are the usual suspects, people who have existing financial centers, let's say Malta, Gibraltar, or what have you. And then people that are not, the usual suspects in this area. Belarus has passed legislation very welcoming of cryptocurrency, and no one would have thought of Belarus as, a world financial hub in any way. And so I think that's the state of today. Now, in all of these countries, I think central banks will look to, is cryptocurrency a threat to financial stability? So even in a country like the United States, where there's no impact really on currency controls and they're not worried about a run on the currency, the Federal Reserve has done multiple policy papers on cryptocurrency and said, we studied it, given its size now, given that banks don't own it, given that it's not highly leveraged, given that it's not super tied to the existing financial system, and given still its overall size relative to the very large U.S. economy, we don't think it's a threat to monetary stability and to the economy, but we're watching it. And so that's a point of view that might change if cryptocurrency got, 10 times bigger. And if people thought, because if you're a central bank, you're trying to organize a smooth um, running of the economy where you have steady growth, low inflation, high employment. And if you think that cryptocurrency, just like any other asset class, is going to cause distortions in the market, then you might take moves against it. So I don't think this is a specific to cryptocurrency situation. Like one of the interesting case studies in the early 2000s is the housing market in the United States and, by extension, the housing market in Canada, where the housing market, by many observers' viewpoint, got bubbly in the United States. But the central bank thought maybe it wasn't and didn't do very much about it. Whereas in Canada, they were a little bit stricter and you didn't have as much of a bubble and a popping of a bubble in housing as you did in the United States. And it's interesting because, what does it mean? What are they going to do about it? I mean, the Federal Reserve doesn't regulate houses, right? But the Federal Reserve and central banks in general can give guidelines and guidance and restrictions on how banks lend to people who want to buy a house. And so if banks think that the bubble's emerging in housing prices and the banks are being very aggressive in lending and ultimately the banks are going to have losses, and if the banks have losses, someone's going to have to bail them out, or consumers will have losses in their deposits, et cetera, et cetera, et cetera. They might come and say, we need you to only lend 70% against the value of the house, not 90% or 100%, or what was happening in some cases in the United States, 110%. And that's a way where, in effect, a central bank can lower the price of an asset, in this case, housing, that they don't have direct control or responsibility over, because they think it would otherwise eventually be harmful to the financial system and then to the stability of the overall economy. And most people think that is a reasonable and rational thing for a central bank to do, and it's part of their responsibilities, and it's not specific to cryptocurrency, right? So it's not, they're picking on cryptocurrency because they're doing this. They have these discussions about anything else that could be large and systemic. Housing is obviously a gigantic asset class, and it's one they'll pay attention to. And so the answer to this question also has to do with how big cryptocurrency gets, right? Like pistachios are also an asset class, but no central bank has ever had a position on pistachios because they're immaterial to any economy. So the price of pistachios might go up, the price of pistachios might go down. People might buy pistachios with loans. I've never heard of it, but I guess it's possible. But central banks aren't going to care. But housing, they are going to care. The view of the United States, and I think a little bit of the European Central Bank, though they're more conservative than the Federal Reserve, is yes, theoretically, there could be financial stability issues relating to cryptocurrency. And in that case, we would feel the need to act. But today, it is simultaneously too small and not so interconnected with the existing financial system, in which case we don't feel the need to do anything other than monitoring. That's the aspect that has to do with financial stability. There's a whole separate bucket of concerns that have to do with anti-money laundering. So the world has absolutely been on a multi-year, multi-decade trend to try and have a better view on money flows throughout the world and throughout different banking and financial systems, in the hope that there will be less money laundering. So this is a topic that raises more concerns for central banks and all types of other regulatory agencies. People talk about it all the time as it relates to cryptocurrency, and they'll never say it this way, but what effectively it's like, we're just starting and still a lot of problems ahead of us to get a handle on the traditional system, and now here's this whole other system, and oh gosh, are we going to go back to square one here if this becomes a big thing? Now, both the Federal Reserve and the Central Bank of England have stated that today there are not material amounts of money laundering happening through cryptocurrencies. I think the Central Bank of England in its report said there are 18 ways you could launder money, and number 18 was cryptocurrency. But again, it's a question of if that is just a temporary scenario until it gets bigger. So when you see some of the statements of the IMF and of Christine Lagarde, who has said, in some ways, some very positive things about cryptocurrencies, that in time, a virtual currency like a cryptocurrency might become quite stable and or appealing and could be a competitor to traditional currencies. She's also said a lot of things along the lines of cross-country regulation of cryptocurrencies might need to come into play, and it's usually wrapped into under the banner of anti-money laundering. Now, some people will say, well, maybe anti-money laundering is just the reason, and the real is just the justification. The real reason is to control it and keep it manageable. Who knows? But I think those are the two big buckets where you'll see central banks get involved. That if it's going to impact financial stability, and then how does it impact anti-money laundering initiatives? And I think as we are now, we have a full spectrum of policy approaches throughout the world, from quite liberal to kind of intermediate to very strict to we don't have a policy yet. So that's my view on central banks and are they going to impose regulations. All right, let's go to the next question. Would there be any point in having a maximum supply for central bank digital currencies, or would that simply defeat the policy tools that are currently used to regulate the market? This is an interesting question because it gets to an underlying, I think one of the important underlying principles, and I have a point of view on this. If you are launching a private cryptocurrency like Bitcoin, I believe the only way you could get it off the ground, the only way the tokens could build some value so the miners will mine them so that you have a security for mining, etc., 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 is if you have a limited supply, so people are willing to invest in them in the hope that because the supply is limited, their value will go up. So, a lot of people call it speculating, but the reality is I don't see any other way to bootstrap a private cryptocurrency, because a private cryptocurrency, nobody has any real reason in the beginning to own it. So if you said, I'm launching Antonis Polemitis coin, and every month I'm going to issue many more of them, and then many more of them on top of that, and then in the future, maybe even many more of them, and there's not even going to be a maximum supply, you might not be so incented to hold Polemitis coin. But if there is a limited supply, and that in and of itself is obviously not sufficient to give it value, but it's probably a necessary, if not sufficient, condition. So if there's a limited supply, maybe you can get this bootstrap going the way Bitcoin did. If you're a national currency, if you're a sovereign currency, you don't have that same restriction, right? Because there is no official maximum supply of euros or dollars that's set in stone somewhere. And yet lots of people hold euros and dollars. And why do they hold euros and dollars? Because euros and dollars are both the unit of account and the medium of exchange in very large economies. So it is sensible to hold euros and dollars. I bought a coffee an hour and a half ago. It was denominated in euros. I paid in euros. It would be less sensible for me to hold any other currency in order to transact these day-to-day things, whether it's US dollars or Litecoins or anything else. So there is a natural embedded demand in an economy for whatever currency is their unit of account and medium of exchange. In which case, if you have a central bank digital currency, I do not believe it is a necessary condition in the same way that it is for a private digital currency to have this maximum supply. What I would instead say is whatever is your existing monetary policy approach would likely port over to your central bank digital currency, cryptocurrency policy approach. Because I believe if you're a central bank, you're not going to want to give up the tools you use to manage monetary policy. What you might find appealing is to have a native digital token, because with a native digital token, you can have native online commerce and machine-to-machine payments and all of these wonderful things that you have with cryptocurrencies. And so it seems to me very plausible that we will eventually have central bank issued digital or cryptocurrencies. And that's in order to pick up their technical aspects, the fact that they're native digital assets, but without necessarily changing their monetary policy approach. Now, I'm not saying any central bank should have a loose, strict, or any in-between monetary policy. That has to do with that central bank and that country's monetary history and the different things they have to deal with. But whatever your policy is, it shouldn't change just because you've offered a cryptocurrency. And in fact, I've thought a little bit about the mechanics of how one would do it. I think you would do it by issuing a supply of that currency in digital form that is much smaller than your overall money supply. So let's say we are, I don't know, Japan, and the total money supply for Japan is some number of trillions of dollars, I would guess. I don't know that offhand. It might make sense for Japan to issue $50 billion worth of crypto yen. Okay, so there is a fixed amount of crypto yen issued, but that amount of crypto yen is only 5% of the total money supply of Japan, and it's exchangeable one for one with yen. And Japan would still have its whole monetary toolkit that it has today by increasing or decreasing the money supply by the same policy tools it uses today. And so that seems to me very plausible over the medium to long term, that big central banks and central banks with serious currencies that people are happy to hold are going to say, yeah, well, we're going to continue conducting monetary policy as we do now. And also we will issue some small percentage of our money supply in a crypto style token that people can transact with natively. So I don't see any reason they couldn't do that, and I don't see any reason why issuing the crypto would have to change one's view on what the right monetary policy is. Now, could you see some small countries that have primarily externally oriented economies or that have had problems with hyperinflation issuing a maximum supply cryptocurrency? Yes, you could. It's a little bit stunt oriented, I think. It's a little bit of a stunt. However, even if you did that, I'm not sure it's really a maximum supply, because you can't really permanently bind a sovereign country to anything. Right? So even if today Paraguay says, I am never going to issue more than this many whatever, crypto whatever, a government 5-10 years in the future can change their policy, and it's not really any way you can stop them from changing that. And so I'm not sure how a sovereign nation can ever make a hard commitment through crypto that it's not the same type of hard commitment they could make without crypto. So really what gives a currency stability or value is, does this country have economic power and political power, and also a long track record of managing its currency sensibly. And none of these things are absolutes. It's all a spectrum, right? Like there's a spectrum from countries that have managed their currency poorly to countries that have managed their currency well, and everything in between. And so I don't think that changes with crypto, and I don't think even issuing a fixed supply would change that, because countries still ultimately retain sovereignty and can decide to do whatever. And, short of going and militarily invading them, you can't really stop them from making new sovereign decisions. So that's my view on that. I think we will have central bank digital currencies at some point. And I think it's going to be orthogonal to money supply and monetary policy tools. Like it's not, we will have those and central banks will still do whatever they were doing previously with monetary policy. So, next question. What is preventing any country from putting 1 or 2% of their GDP in Bitcoin? Conceptually, nothing. It would have to be a country that is innovative, not afraid of ridicule, because at first a lot of countries will be making fun of them, not necessarily for good reasons, and willing to gamble a little bit. It's funny because if you are willing to do this on a trading basis, I think a country that did that could make a very profitable trade, right? So if today any semi-serious country went and accumulated a meaningful number of Bitcoins and then went out and announced, hey, I am so-and-so country and I have accumulated this many Bitcoins, I am sure the price of Bitcoin would jump over the short term, because everyone would say, oh, look, here it comes. Central banks are going to start holding Bitcoins as well as their gold reserves, and you'd trigger a bubble. So that's, or trigger a pump, let's say. So I think that would work. The problem is problem in quotes, central banks don't really do that, right? Like central banks could do that with other assets as well. And they're not really, that's the type of thinking you would do on a trading desk. And central banks really aren't set up to do that. It's not really within their policy goals. And so I'm not sure that will happen that way. If the fully bullish case happens for 1 or 2 cryptocurrencies and they get very, very big and very, very stable over a long period of time, could some central bank hold some? Conceivably. I don't see any major central bank doing this in the immediate term. Maybe some small country will do it as a stunt. I don't know. Could be an interesting publicity stunt for a small country, right? If you're one of these jurisdictions who's saying, I want to be viewed as a country that is favorable to cryptocurrency, and I want to be viewed as a country that people should move their cryptocurrency companies to, because I'm interested in picking up that business, and I have put 1% of my reserves into XYZ cryptocurrency. I think that stunt could work, but I think it's a little bit of a stunt at this stage, as opposed to something that's likely to happen. Okay, most of us believe in Bitcoin because it is decentralized. Won't a central bank digital currency defeat this core purpose? It's interesting. So there's a question of what that means, right? So like, why are we interested? Because it is decentralized. What's the part what aspect of that is the interesting part? Because people mean different things when they say it. One of the things they sometimes mean is central banks tend to be a little bit inflationary, so therefore it's not hard money, and I want to hold on to some hard money because it'll do better over time. And the decentralization of, say, Bitcoin, excuse me, the decentralization of Bitcoin is what gives me confidence that the money supply won't change. Right? So think about what we said before, that if you're a national issuer, you can come back and change the money supply in effect. The fact that getting Bitcoin developers to agree on much of anything tends to be a painful process, and getting developers and miners and users and all of that to agree to a supply chain, I think, would be a very, very difficult process. Supply chain would be a very, very difficult process. It is probably safe to say that it's unlikely to imagine Bitcoin changing its maximum supply. I mean, there might be some conditions, but it's unlikely. So in that case, yes, it's true that a well-established, scaled-up digital currency that is fairly decentralized like Bitcoin is likely to give a stronger commitment to a total money supply than a national currency. Doesn't mean it's going to be a better currency, by the way, or it's going to perform better. I think nobody knows that. But I can probably give a stronger commitment to that because, as we mentioned earlier, simply having a cryptocurrency issuance shouldn't necessarily change your monetary policy as a central bank. Now, there's another part of decentralization, though, that sometimes people mean when they're talking about decentralization. And what they mean is censorship resistance. So the decentralization allows for censorship resistance. And what does censorship resistance mean in this case? It means that there is no central party subject to, 51% attacks that can decide that a certain transaction can be blocked. And that is absolutely a feature of private cryptocurrencies that exists today that does not exist in the current financial system. So if in the current financial system someone decided that Antonis Polemitis was in some type of trouble and shouldn't be transacting with his bank accounts, you could freeze Antonis out. So the this censorship resistance does exist. And so here we get to an interesting question. Would a central bank issued digital currency or cryptocurrency be censorship resistant? And the answer is, of course, it could be. But I suspect a lot of central banks would be afraid of making it censorship resistant. So what does that mean? For it to be censorship resistant, you'd have to have a kind of proof of work type algorithm like you have with Bitcoin, and hope that there's a diversified set of miners, blah, 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 that no one can actually block transactions and be permissionless and decentralized. A lot of central banks are going to say, oh, well, gosh, that makes me uncomfortable for KYC AML reasons. I was 2 years ago talking at length to a central banker, you own the Federal Reserve. I said, guys, if you issued a true cryptocurrency, you issued a Bitcoin fork and just said, hey, this is tradable for dollars, 1-to-1, that would absolutely get traction because it would give people the ability to have programmable money without taking on currency risk. And he said, oh, God, that's going to be very uncomfortable for us because we have all our KYC and MAL, and I'm not sure we can just let any random person who might be some good guy in Kansas or might be someone who we're trying to sanction have access to this system. And so I do think on monetary policy, it's going to be irrelevant because monetary policy can be separated from if you're issuing a digital currency or not. But for censorship resistance, I'm guessing, I don't know, I'm guessing, this is just a guess, that central bank digital currencies will not be censorship resistant, at least at first. And if that's the case, that will leave a usage case for private cryptocurrencies, and that usage case subject to how aggressively people crack down on them, right? Because there is a spectrum. There is absolutely a spectrum of, sure, cryptocurrency is censorship resistant, but it's more censorship resistant when the state isn't going after you, and less censorship resistant when the state is going after you. If the state started showing up to mining facilities and, shutting them down and putting everyone in jail, there would be fewer miners. And you would eventually get to a less robust mining infrastructure. And it wouldn't be particularly hard to find the miners. They tend to draw a lot of electricity, and so people tend to know where they are. Now you say, well, is that within one country, within multiple countries? That's the big bet of whether or not, hold on one second. That's the big bet about whether or not a cryptocurrency can ultimately survive a nation-state attack, which is how broad the attack's going to be. If one country goes after it, what we've seen so far is the activity just moves to another country, right? So a lot of the trading that was happening in China moved to Japan and to some degree to South Korea. If 50 countries made a coordinated effort against it and said, yeah, we're done with this, we want to shut it down, that's interesting. Like that would be harder. So I think for long-term survivability of a private decentralized cryptocurrency, it would want to get as many states feeling that they had an economic incentive to keep it legal and draw the business to them, so that you couldn't get coordinated action and say, well, yeah, I understand you don't want this, but I don't want to lose this industry and tax revenue that I'm getting from these businesses in my country today. So I think that's a complicated question. But I think if there's one thing that will differentiate a private cryptocurrency like Bitcoin, its single most important feature is going to be censorship resistance. Everything else arguably are copyable by either existing systems or new systems, built on top of existing systems. Related question. Is it possible that governments will restrict access to Bitcoin through mining by making private mining illegal and only allowing Bitcoins that were provably mined by a state-approved and owned mining operation? Sure, of course, anything's possible, right? Like you could, that's not the worst case scenario. The worst case scenario is just to make Bitcoin mining illegal, full stop. And would it go away completely? No. Bitcoin is probably already impossible to kill completely, right? There are enough jurisdictions on the planet, enough thousands of people with full nodes or miners and millions of people with wallets that taking it out of commission completely, difficult. But you could, in effect, slow down and reverse its adoption and make it a niche thing. Yeah, I think you could. If there was coordinated, extremely rough government action against it, like by extremely rough, I mean at the level of you're showing up with guns at people's mines, there's not going to be industrial mining in any country that does that. And so then the question is, will there be enough safe jurisdictions left to keep a high rate of hash power and blah, 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 and so on. So I think that's one aspect. There's even a more extreme version of this. We saw this in Egypt during the some of the protests a few years ago, where people were coordinating through social media, and effectively the government just pulled the plug on the internet countrywide. And it's funny because they say, wow, that's, not in your day-to-day threat model, because you say, well, people need the internet. And they do, of course, but if a government is alarmed enough that something might get out of control enough and threaten the government's survival, it becomes in their interest to say, sure, I'll lose a few days of economic productivity, but I'm playing for my whole survival here. So whatever. And, you have a centralized internet provider and you tell them, please turn the power switch off. So if you want to have a fully censorship-resistant internet, which is kind of a subset or superset of having a fully censorship-resistant cryptocurrency, you probably need to get all the way to mesh networks. And so where people's devices can ultimately just communicate with each other's devices without going through a internet service provider. And this is something that's been talked about for a very long time and does not exist in practice yet, though people are working on it. So that mesh, if you got to the point where mesh networks got established and you couldn't shut down the internet at all, and you had a currency that didn't, let's say you had a proof of stake currency and a mesh network internet, that could conceivably be hard to shut down because you don't have the concentration of electricity drawdown that centralized mining gives you. And you can't shut down the internet. To the degree that you can still shut down the internet, and pretty much everywhere you can still shut down the internet, you can put a serious dent in a cryptocurrency as a subset of putting a serious dent in people's electronic communication. But it's interesting. It's interesting. The a lot of the developed countries are saying, no, we like this industry. We should let it develop and keep an eye on it. The Senate report on cryptocurrency that came out in the United States a couple weeks ago was quite positive. It said, let's not rush to judgment. This could be a area that leads to innovation, economic development, and so on and so on. And of course, we have to watch it, but let's not be too conservative yet. All right. Do you believe the advent of cryptos marked the end of the current financial system of fiat currencies, along with the different economic theories? Will a new generation of crypto economists emerge? I do not believe either of those two things. And here it's interesting I'm a super booster of this area. I think it's a very big deal. I think cryptocurrencies are going to be very important in the future. And despite that, unlike a lot of people who believe that, I don't think it's going to upend macroeconomics necessarily, because, it's not at its core a vastly different macroeconomic policy than, say, gold, right? So we have had currencies before, monetary theories before, based on fixed-ish supply with gold standards. And every time we've had a gold standard, it tends to eventually crack and countries go to a different type of currency issuance. And so it's not clear to me why this would be different. So it doesn't mean that, so gold has value, right? And a digital gold oriented cryptocurrency, if it succeeds, could also have value. But I don't see why that would mean that people wouldn't use sovereign currencies, more Keynesian sovereign currencies for macroeconomic purposes as they do now. Because if that wasn't the case, so if my theory is wrong, why aren't people rushing to go onto a gold standard now? Right? We've been going the other direction. So I'm not sure crypto economics is actually any different than regular economics. I mean, we have economic theories that think through what a fixed supply of money would look like. And that wasn't invented just because Bitcoin was invented. What you're seeing is a digital version of that. And conceivably, that could be more adopted and more useful than an analog version of that. Like if people got to the point where they really believed that a particular cryptocurrency was like digital gold, realistically in 2018, a digital gold is probably more useful than, a gold coin, right? So you could see it being successful. You could see it being an important part of an overall financial system, but I don't see it replacing macroeconomic policy tools because they exist for a reason. They're helpful to many of government's objectives, and I don't see why they would stop being helpful to those same government objectives just because Bitcoin exists. So I guess we will see how this plays out. I know there's people that have much stronger opinions on this than I do, but that's where I am right now. All right, other question. If a bank allows account owners to own a balance in crypto coins to facilitate small payments, won't it be beneficial for them since they'll have no maintenance and security costs for those balances? Plus, they'll have a profit from changing to fiat to crypto and back, just like they do with foreign currency. Well, this sounds like a hosted wallet. I don't think it is accurate to say that a hosted wallet will have no maintenance and security costs for the person hosting that wallet. In fact, the security costs in particular are going to be a huge nuisance for the person running that system because cryptocurrency is wonderful in many ways, but the fact that it's a native digital asset makes it very easy to steal. And so if you are running a hosted service of holding Bitcoins or Litecoins or Zcash or Ethereum or whatever, you're going to spend an awful lot of time, energy, and stress on security that you're not incrementally spending on your existing system. So you obviously spend a lot of time on security in your core banking systems as well, but those are built. Those are there. Those you've had decades and decades and decades of getting them to where you want them to. And if tomorrow you're Citibank and now you want to build a system that allows your customers to hold Ethereum and your customers expect that you're not going to get hacked and lose their Ethereum, that actually sounds to me like a lot of work and a lot of anxiety. And today, for the average business executive at a bank, probably more downside than upside. Which is why you see these things being independent companies, because for an entrepreneur, it's more upside than downside. If you start a cryptocurrency exchange or wallet or whatever, and it fails, well, you didn't have anything before, you don't have anything now. If you are Citibank or a manager at Citibank and you say, let's go do this thing, and then it fails and you somehow lose $1 billion of cryptocurrency, either you're going to go deep into Citibank's pockets and pay out the customers so they're not upset, or you're going to let them lose all their money and lose all types of brand value as Citibank because you're now the place that lost $1 billion of people's wealth. So you can see why at this stage, where it still feels difficult and scary and people are still working through the systems for running cryptocurrency securely, why if you're a big conservative institution like a bank with conservative people like managers of divisions at banks, because you don't become a manager of a division at a bank by being an extremely off the charts wild type of person. How you might think the risk reward is still on the side of let's not do anything right now. And if and when the day comes that we decide that we should be in this business, I think what they're going to do is go buy an existing exchange, right? It's a lot easier to say, fine, these guys have spent 15 years, 10 years building this exchange. They have the process, they have the team, they have the engineers. It works. Let's go buy them, instead of saying, let's start hiring crypto security talent into Bank of America to build those from scratch. Because, by the way, the types of people that are good at these things probably aren't super psyched to go work for a big bank. So you're probably not going to get the absolute best cryptocurrency experts to come work at a big traditional bank. So I think it's over optimistic to believe that it is a no security, no maintenance cost exercise to offer crypto wallets as a big bank. What's your view of India's ban on cryptos? Fairly strict. Not very surprising. You have a government in power in India that is trying to bring the financial system under its control and doing some very unusual experiments to do that. So I went to India about 15 months ago, and I landed in India the day they announced their surprise demonetization, where they suddenly said, your cash is no good here anymore. Like, all Indian cash wasn't good for commerce anymore, and you had to go take it and deposit it at the bank in order to get a working balance with your cash. And this was a very extreme move. Like, I have not seen, I can't think of any example in recent history of a country just out of the blue saying, yep, all the cash in your wallet, in your safe, in underneath your mattress cannot be used as of today. Please go deposit it at your local bank branch. And why exactly? Well, the idea is that a lot of it might have been ill-gotten cash people hadn't paid taxes on. And so by forcing people to take it to the bank and declare it, you would get a handle on this kind of black economy money. Needless to say, it caused endless aggravation for, in India's case, more than 1 billion people who are not money launderers or tricksters or what have you. And on the whole, I believe the economic analysis I've seen about this was that it wasn't worth the effort. Less black money than they expected came into the system, and it had a productivity impact because suddenly you had, for a few weeks, people just sitting around in line at the bank trying to sort this out. And as in most of these cases, it hurts the poor more than it hurts the rich, and as a general rule, because they're more likely to be unbanked and have cash, and this whole thing being a big aggravation for them. So, wasn't a great experiment, I believe, but it was a very bold one, and it was a very centralized command and control one. So a government that was willing to do that to their own sovereign currency, right, to their own fiat, who was willing to declare the cash format of fiat sort of illegal if you didn't go turn it in immediately, well, it's not totally shocking that that same government wouldn't be thrilled with cryptocurrency. So it is a strict ban, but it is not an unexpected one, I think. Okay, I think that is it for today. We have ran through our time. Thank you, everyone, for joining. Thank you, everyone, for the questions. For those who celebrated Easter last week, happy Easter last week. For those celebrating Easter this week, happy Easter this week. For those not celebrating Easter at all, have a great weekend this weekend. And we will see you all next week. Thank you very much, everyone.